work from home, or maybe you work from 3 different states, or a beach in Florida while your employer is in New York. The remote work revolution created an entirely new set of tax challenges that millions of Americans are completely unprepared for. If you work remotely, this video could save you from a very unexpected and expensive tax surprise. Welcome to taxmerica.co, your trusted source for US tax guidance. I'm Sharon, and today we're covering everything remote workers need to know about taxes in 2025. We'll go through the home office deduction, who qualifies and who doesn't, the multi-state tax trap and how to handle it, tax implications of working abroad as a US citizen, what W-2 employees versus freelancers can deduct, and strategies to keep more of your money. Let's get into it. The big rule: exclusive and regular use. The home office deduction is one of the most misunderstood deductions in the tax code. Here's the number one rule: the space must be used exclusively and regularly for business. Not mostly business. Not business and occasional Netflix. Exclusively business. That spare bedroom that also has a guest in bed doesn't qualify. A dedicated room used only as your office, that qualifies. W-2 employees are not eligible currently. Here is the most important thing W-2 employees need to hear. As of the Tax Cuts and Jobs Act 2017, W-2 employees can no longer deduct home office's expenses on federal taxes, even if they work from home 100% of the time at their employer's request. This provision is in effect through 2025. Some states, like California and New York, still allow this deduction on state returns, so check your state rules. But federally, if you receive a W-2, you cannot deduct your home office. Your employer can, however, reimburse you tax-free under an accountable plan. Talk to your employer's HR or finance team about setting up an accountable plan for home office reimbursements. This is tax-free money for you, and deduction for them a win-win. Self-employed and freelancers, 2 methods. Simplified method: multiply your home office square footage by $5 up to 300 square feet. Maximum deduction $1,500. Simple, no depreciation recapture issues. Great for small offices or when your actual expenses aren't much higher. Regular method: calculate the percentage of your home used for business. Office square footage divided by total home square footage. Apply that percentage to your actual home expenses: rent or mortgage interest, utilities, insurance, repairs, and depreciation. More complex but often results in a large deduction. Note: if you own your home, taking depreciation creates a potential tax liability when you sell, called depreciation recapture. Here is a pro tip: if you rent, the regular method is almost always better. If you own your home and plan to sell soon, consider the simplified method to avoid depreciation recapture. A taxmerica.co advisor can model both scenarios for you. What expenses does the home office deduction cover? Rent: the percentage of your rent attributable to the office space. Utilities: electricity, gas, water. The business use percentage. Internet: the business use portion of your internet bill, often 50 to 80% for remote workers. Renters or homeowners insurance: the business use percentage. Repairs: if a repair benefits only the office, it's fully deductible. Whole home repairs, apply the percentage. Depreciation, homeowners: complex but can be significant. Work with a tax professional. Why multi-state taxes are complicated? One of the most underappreciated tax challenges for remote workers is state taxation. The basic rule: states tax income earned within their borders. If you physically work in multiple states during the year, you may have tax obligations in each of those states, even if your employer is only in one state. And if your employer is withholding taxes for their state while you work in a different state, you could be paying taxes to the wrong state or both. The convenience of the employer rule. Some states, including New York, Nebraska, Pennsylvania, Delaware, and Arkansas, have what's called the convenience of the employer rule. Under this rule, if you work remotely from another state for your own convenience, not because your employer required you to, your income may still be taxed by your employer's state. This means a New Yorker who moved to Florida may still owe New York income tax on their salary, even if they never set foot in New York all year. This is one of the most surprising and costly rules for remote workers who relocated thinking they escaped high tax states. Here is a case study. Maria moved from New York to Texas in 2023 for a better quality of life. Her employer stayed in New York. She assumed she'd pay no state income tax since Texas has none. But because New York's convenience rule applied, she still owed New York state income tax on her full salary. Taxmerica.co helped her document that her remote work was employer required, significantly reducing her New York tax exposure. How to handle multi-state filing? If you worked in multiple states, here's the general process. First, determine which states have a nexus claim on your income, where you physically work and where your employer is located. Second, file a non-resident return in each state where you earn income. Third, claim a credit on your residential state, return for taxes paid to other states. Most states offer this credit to avoid true double taxation. Fourth, work with a tax professional who understands multi-state rules. This is not DIY territory. Here is a pro tip. Keep a day-by-day log of where you physically worked each day, especially if you travel between states or travel for businesses. This record is your first line of defense in a multi-state audit. Moving to a no income tax state. Florida, Texas, Nevada, Washington, Wyoming, South Dakota, and Alaska have no state income tax. Many remote workers have relocated to these states for this reason. But be careful. You must establish a genuine domicile in the new state. That means driver's license, auto registration, vehicle registration, changing your primary address on all accounts, and spending the majority of your days there. High tax states like California and New York aggressively audit people who claim to have moved out but maintain significant connections to the state. The US global tax system. The United States is one of only 2 countries in the world that taxes its citizens on worldwide income regardless of where they live. If you're a US citizen or green card holder working abroad, even temporarily, you still owe US taxes on your income. There's no escape hatch just because you're overseas. However, there are powerful exclusions and credits that can dramatically reduce or eliminate double taxation. Foreign Earned Income Exclusion. The Foreign Earned Income Exclusion (FEIE) lets qualifying US taxpayers exclude up to $126,500 of foreign earned income from US taxes in 2024. To qualify, you must feel either the bona fide residence test, living in a foreign country that as a resident for a full tax year, or the physical presence test, being in a foreign country for at least 330 full days in any 12-month period. You claim this on Form 2555. This is a huge benefit for all digital nomads and expats, but the rules are complex and mistakes are costly. Foreign tax credit. Alternatively, you can claim a credit for foreign taxes paid. This can be more beneficial than the exclusion in some situations, particularly in high tax countries. You cannot use both the FEIE and the foreign tax credit on the same income. It's one or the other, or a combination with careful planning. FBAR and FATCA. Don't ignore these. If you have financial accounts in foreign countries with a combined value exceeding $10,000 at any point during the year, you must file an FBAR, Foreign Bank Account Report, through FinCEN, not the IRS. Separately, FATCA, the Foreign Account Tax Complaints Act, requires you to report foreign financial assets above certain thresholds on Form 8938. These are separate filings with severe penalties for non-compliance, up to $10,000 per violation and potentially much more for willful violations. Here is a pro tip. Working abroad, even temporarily, contact taxmerica.co before you go. Setting up your tax situation correctly from day one is far easier than unwinding mistakes after the fact. What self-employed remote workers can deduct? Internet and phone. The business use portion of your internet and phone bill. Document this carefully. The IRS expects reasonable allocation, not 100% unless truly justified. Ergonomic equipment, desk, chair, monitor, keyboard, headset, webcam. If purchased for your home office and used for business, these are deductible. Under Section 179, you can deduct the full cost in 1 year. Video conferencing tools, Zoom, Microsoft Teams subscription, Slack, Notion, project management software, all deductible as software subscriptions. Professional development, online courses, certifications, books, industry memberships that can maintain or improve your current skills are deductible. Co-working space memberships. If you sometimes work from a co-working space, the membership fees and day passes are fully deductible business expenses. What W-2 remote workers can ask their employee for? Even though W-2 employees can't deduct home office expenses federally, your employer can help tax efficiently. Ask about an accountable plan, reimbursement for home office costs, tax-free to you, deductible to them. QSERA, a qualified small employer health reimbursement arrangement, if applicable. Remote work stipends structured as business expense reimbursements rather than taxable income. Key takeaways. W-2 employees cannot deduct home office expenses federally, but can seek employer reimbursements. Self-employed remote workers have powerful home office and equipment deductions available. Multi-state work creates complex filing obligations. Keep a day log of where you work. Relocating to a no-income tax state requires genuine domicile, not just a new mailing address. Working abroad, the FEIE can exclude up to $1,026,500 of income but file FBAR and FATCA on time. Get professional help for multi-state or international situations. The savings far exceed the cost. Remote work is wonderful, and it doesn't have to be a tax nightmare if you're informed. At taxmerica.co, we handle remote worker, multi-state and expat tax situations every day. Visit taxmerica.co to book your free consultation, and let's make sure your remote work setup is optimized for taxes. Subscribe, like, and we'll see you next time. If this video helped you, like it and subscribe for weekly tax tips. Drop your questions in the comments and we read every one. Book a free 15-minute tax consultation at taxmerica.co and let our experts handle your taxes stress-free this season. Thank you.